everyone to day 2 of DC Fintech Week. My name is Chris Brummer. I'm going to be making a couple of quick introductions before we have Governor Barr's speech. Just a couple of operational notes for today. We are doing something that we have never done before, if you are a longtime visitor of DC Fintech Week, which is we are having multiple events on multiple floors to create a very unique experience. Fintech is about experimentation. Well, I guess events this year is one big experiment, so any patience with us is helpful. This is a little bit of a proof of concept, and we will refine it like any good startup over the next couple of years. Just for note, if you go and you look at any of the QR codes on any of the floors, those QR codes will bring you to dcfintechweek.org. If you go to the agenda page of dcfintechweek.org, you will see what is happening. It'll first show you the AWS schedule, and you scroll through, and you can find everything that's happening if you want to know on what floor or in what area our programming will be taking place. And we have, obviously, quite a few very heavy hitters for the event. I did want to also introduce sort of a concept, because I can't be multiple places in one time and no one would want to see me in the first place. So I'm going to have a couple of MCs/CEOs for the different floors. Adam Minehardt from Chainlink will be guiding you through all of the day's programming on this floor, where we will be dealing and delving into the market infrastructure of crypto, into DeFi, decentralization, what that means. Lots of stuff in the news in the last week or so, and to kind of delve into those issues. But, and we'll be ending very much on time for all these things, because we're going to have a ton of people here, and we want to be able to shuttle you from one floor to the other without getting too much of a traffic jam for the stairs. You will get your exercise in, but we have the air conditioning on, so you'll be cooled off. Okay, with that, I'm going to have just a quick 1-minute introduction, because you guys don't want to hear from me, but it was helpful to know about the QR codes. I am delighted to kick off this very first iteration of our experiment with the man who knows a lot about experimentation that's going on in our nation's financial system, my friend, my colleague, Professor Governor Michael Barr. We all know who he is. And Governor Barr has seen innovation taking place throughout the financial system, from banks to protocols, and I thought that it was both extraordinarily generous for him to come. He's been here since even before his official capacity, and now you are keeping that run up. So thank you so much, Michael. I'm just Governor Barr. I will just pass over the microphone to you. Thank you.
As all of you know, payments innovation has been accelerating. Stablecoins, artificial intelligence, real-time payments, and richer payment metadata offer significant improvements to the cost, speed, and functionality of payments. Better payments functionality can help financial institutions and businesses manage liquidity more efficiently at lower cost. It can also mean that people receive their paychecks more promptly and manage their payments more efficiently. Payments innovation is especially important for lower-income individuals who are often underserved by the financial system and lack financial slack. For the bulk of my remarks today, I want to focus on one kind of innovation, the benefits and risks of stablecoins. Congress has recently passed legislation that provides some clarity to issuers of stablecoins about how they can fit into the regulatory and supervisory framework. While there is a lot of work to do on the part of the government to fill in the specifics during the rule-writing process, increased certainty could lead to more rapid development of stablecoins and related products and services for businesses and households. I want to start with some of the potential benefits of stablecoins. The primary benefit comes from the ledger itself, which can operate globally and encode functionality and conditionality directly into assets and transactions. This functionality unlocks a range of new financial use cases that were previously impractical when transactions required updating a series of ledgers spread across individual financial institutions. The global nature of stablecoins is fundamental to their usefulness in parts of the payment system that have high friction, such as cross-border payments. Some of these frictions are necessary and important, such as those associated with complying with relevant laws and regulations on money laundering and terrorist financing. But removing or mitigating other frictions may reduce costs and facilitate more efficient transactions. While today stablecoins are mostly used to facilitate crypto trading activities, and secondarily as a dollar-denominated store of value in some foreign jurisdictions, I want to provide some examples where stablecoins may be useful for additional functions in cross-border payments. For example, stablecoins can be used to reduce the cost of remittances, since it tends to be more expensive to send remittances to jurisdictions with less developed domestic payment systems. As of a few years ago, stablecoins had only a limited ability to reduce costs because there were meaningful fees associated with on-ramping into stablecoins and off-ramping out to local currencies. However, stablecoin acceptance networks have arisen in some corridors that help reduce these fees and offer the potential to reduce the cost and increase the speed of remittances for those least able to bear these costs. Stablecoins also have the potential to improve the speed of managing the paperwork and processes inherent in global trade and trade finance, perhaps with the use of smart contracts. In these applications, a digitally native form of payment could potentially be used to streamline the tracking and validation process that occurs between financial institutions, shipping companies, and customs warehouses, and the companies that engage in trade. Small businesses might see lower costs and greater access. And for larger firms that have entities across the globe, stablecoins may help with treasury management. Stablecoins offer the promise of near real-time global payments, helping multinational firms manage their cash efficiently between their related entities, while still making payments through local internal entities in different countries, reducing costs and improving liquidity. I have mentioned just a few of the potential ways in which stablecoins can provide benefits to households and businesses. Continued investment in technology can also support compliance with important legal restrictions that prevent the use of the financial system for nefarious purposes. This investment will be a key area necessary for supporting stablecoins in achieving their potential benefits. Let me start with money laundering and terrorist financing. One unique feature of stablecoins is their role as bearer instruments, similar to old-fashioned traveler's checks, but mostly operating on global permissionless networks that can include plenty of users with bad intentions. That creates particular challenges for preventing money laundering and terrorist finance, since bad actors can purchase stablecoins in secondary markets that may not have customer identification requirements. The U.S. puts a heavy premium on ensuring that all financial institutions comply with rules that seek to prevent criminals and terrorists from using our financial system. Financial companies, particularly banks, that take shortcuts on anti-money laundering compliance sooner or later come to regret those shortcuts. Compliance with Bank Secrecy Act and anti-money laundering requirements can be very data-intensive and costly, requiring significant staffing to identify and then address or resolve flagged issues. Permissioned networks with only trusted nodes doing the know your customer work can reduce the risk. Moreover, new technologies used with care can potentially reduce frictions on legitimate payments and speed up the identification of problem payments. AI may be well suited to flag payments that are outliers relative to typical patterns, potentially reducing the volume of false positives and unnecessary filings. There may also be ways to improve the explainability of payments if they travel through the payment cycle with more data elements, such as those in ISO 20022 standards recently implemented on Fedwire. There are also technologies that can aid with stablecoin compliance, such as trusted identity tokens and wallets that satisfy customer identification program requirements, and smart contracts that freeze stablecoins in problematic wallets. This suite of tools can also be used for preventing other types of crime, such as fraud. A second key area to consider is financial stability. Let me take a step back and explain why I'm focused on the financial stability risks of stablecoins. Caution is warranted because of the long and painful history of private money created with insufficient safeguards. The fragility of private money is inherent in the way that it is created. Financial institutions issue liquid liabilities to the public that are redeemable on demand and at par, but issuers risk being ultimately unable to liquidate their assets promptly at par when facing run dynamics and market stress. Maturity and liquidity transformation can have social benefits by meeting the needs of the public for money-like assets and supporting the supply of credit to the real economy. However, for this social benefit to be durable, maturity transformation necessarily requires safeguards that address run risk. Looking at the long history of runs from private money is a helpful reminder of how these runs can happen and what's at stake when they do. For example, in the 1800s, during the so-called free banking era, the United States has competing forms of private money in the form of banknotes. The value of these notes was tied to the creditworthiness, location, and credibility of the issuing bank. Although some of the notes were backed by bonds issued by the state governments, as well as other high-quality liquid assets. Despite these protections, the quality of the guarantees backing the banknotes was not beyond question, and they often traded below par. Concerns about the health of issuing banks, or of the states themselves in this era, result in regular bank runs, and in a number of instances, widespread financial panics. The stability of the system was improved over time, such as through legal changes that effectively required banknotes to be backed only by U.S. government securities. Nevertheless, regular episodes of runs continued to materialize until the Panic of 1907, which prominently featured a run on trust companies that offered deposit products backed by assets less liquid than the assets held by banks of the era. This episode led to the creation of the Federal Reserve System. The historical examples point out that issuing liquid liabilities redeemable at par but backed by assets, even high-quality ones, about which creditors might have questions, makes private money vulnerable to run risks. These same dynamics occurred even in much more modern times. The most notable example is when the Reserve Primary Fund broke the buck on September 16, 2008, one day after the bankruptcy of Lehman Brothers, as the assets backing the fund came into question. Pressures on money market funds also occurred in the onset of COVID-19 at the outbreak in March 2020, when institutional prime funds suffered outflows of about 30% of their assets under management within a period of 2 weeks. These experiences show the vulnerability of private money-like assets to runs, and how these runs can threaten not only the financial sector, but also the broader economy. The mostly unregulated stablecoin market has also experienced run dynamics in recent times. While people purchasing something called a stablecoin might reasonably assume that they can rely on redemption at par and on demand, unregulated stablecoins are currently backed by a range of non-cash reserve assets that can make them vulnerable, especially under stress conditions. Three key features, redemption on demand, at par, and backed by non-cash assets, render stablecoins susceptible to runs similar to fragile banks or money market funds. Because stablecoins are not backed by deposit insurance and stablecoin issuers do not have access to central bank liquidity, the quality and liquidity of their reserve assets is critical to their long-run viability. At the same time, stablecoin issuers traditionally retain profits from investing reserve assets, and therefore have a high incentive to maximize the return on their reserve assets by extending the risk spectrum as far out as possible. Stretching the boundaries of permissible reserve assets can increase profits in good times, but risks a crack in confidence during inevitable bouts of market stress. The incentive to reach for yield can grow especially in lower interest rate environments. Stablecoins will only be stable if they can be reliably and promptly redeemed at par in a range of conditions, including during stress in the market that can put pressure on the value of or otherwise liquid government debt, and during episodes of strain on the individual issuer or its related entities. To address these vulnerabilities in the largely unregulated stablecoin market, Congress passed the Bipartisan Genius Act. The Act's primary tool to mitigate the risk of runs is limiting permissible reserve assets to an itemized list of highly liquid assets. This is a significant improvement in an area where reserve assets for stablecoins have been highly varied. Tight control over reserve assets, coupled with supervision, capital, and liquidity requirements, and other measures, could enhance the stability of stablecoins and make them a more viable payment instrument over the long term. But success in accomplishing these goals will depend on the details of regulatory implementation. The Genius Act provides a helpful statutory framework, but it will be up to both federal banking agencies and the states to coordinate and develop a comprehensive set of rules that can fill in important gaps and ensure that there are robust guardrails to protect users of stablecoins and mitigate broader risks to the financial system. Regulators have a lot of work to do to implement the Act, and I'll outline several areas that will require close attention. For example, some of the enumerated reserve assets backing stablecoins are not immune to stress. Permissible reserve assets include uninsured deposits, which were a key risk factor during the March 2023 banking stress. While the Genius Act permits regulators to limit the concentration of reserve assets in uninsured deposits, it will matter a lot how these rules are written. Additionally, in connection with overnight repo, the Act permits any medium of exchange authorized or adopted by a foreign government to be held as a reserve asset, a category that could potentially include volatile assets. For example, until quite recently, El Salvador treated Bitcoin as legal tender, and it still specifically permits Bitcoin to be used for transactions on a voluntary basis. As a result, an issuer could argue that Bitcoin repo could qualify as an eligible reserve asset for a stablecoin. In a case of a stress experienced by the issuer counterparty, or if Bitcoin were to drop sharply in value, a stablecoin issuer could be stuck holding the Bitcoin that had declined in value, potentially compromising the one-to-one backing of the stablecoin liabilities. To the extent possible, regulation should be put in place to eliminate or minimize such risks. In addition to the potential vulnerabilities of some permitted reserves, other aspects of the Genius Act might permit risk to develop unless carefully regulated. The Act permits 4 federal agencies and agencies in each state and territory to serve as the primary regulator and supervisor of stablecoin issuers. As a result, there might be a great deal of heterogeneity in the regulatory frameworks that apply to permitted issuers, despite controls in the Act intended to provide that the frameworks are substantially similar. The resulting array of charter choice options, unless carefully managed, may provide incentives for regulatory arbitrage. For example, the Act permits federal and state regulators to authorize stablecoin issuers to engage in a broad range of digital asset service provider and incidental activities, other than stablecoin issuance, including potentially acting as a crypto asset exchange or broker-dealer. Issuers are likely to seek to stretch these activities' limitations. In fact, issuers could argue that they are permitted under the Act to perform the full range of activities conducted by FTX, provided that they make the relevant representations and conduct appropriate accounting. Unless state and federal agencies carefully coordinate, this could result in some state or federal regulators permitting a range of activities that might expose stablecoin issuers to increased risk. The potentially broad set of permissible activities could raise heightened concerns in cases where stablecoin issuers are subsidiaries or affiliates of banks. In such cases, the risks of expanded activities could affect the banking organization and the banking system more broadly. These risks are especially elevated because the Genius Act carves stablecoin issuers that are part of a banking organization out of bank and bank holding company consolidated capital requirements, even if they conduct a broad range of activities that pose risks that are greater than and different from those associated with stablecoin issuance. Stablecoin issuers are only subject to the capital requirements implemented under the Act, which could end up being too narrow to cover the risk of these expanded activities. Thus, appropriate capital requirements are another area where coordination among federal and state regulation is key. and may be facilitated by the Genius Act's framework for assessing that state requirements are substantially similar to federal requirements. Relatedly, the Act enables stablecoin issuers, including those that may conduct an expanded range of activities, to be chartered by regulators as uninsured national or state-chartered trust banks. This authorization and related decisions by regulators may result in trust banks that engage in a broader range of non-fiduciary, non-custodial principal activities. Let us not forget a harsh lesson learned in the panic of 1907. A lighter weight regulatory framework for trust-chartered entities conducting bank-like activities can create opportunities for regulatory arbitrage and vulnerabilities for the financial system. Overall, these and other gaps may have implications for the safety and soundness of stablecoin issuers. The Act also has gaps related to consumer protection. For example, it does not apply to all instruments that are commonly referred to as stablecoins, and certain dollar-denominated tokenized products can continue to be offered and sold without being subject to the regulatory framework under the Act. This risks creating confusion and could result in consumers relying on payment instruments that they believe are regulated, but which there are no prudential protections of any kind. To mitigate this risk, federal and state regulators should work together to prevent misrepresentation, including through their authority to prohibit unfair and deceptive acts and practices. The Act also lacks sufficient protections to prevent the mixing of bank-like activities in commerce, which could lead to an increase of economic concentration and create competitive distortions, potentially to the detriment of consumers. And finally, the Act does not provide consumers with the fraud protections applicable to traditional payment instruments, including protection for unauthorized transfers. I have talked extensively about how the potential benefits of stablecoins can only be achieved if stablecoins can be reliably redeemed at par under a wide range of conditions. Importantly, the technology that supports stablecoins can also be used for other products, for example, tokenized deposits. The benefits of tokenized deposits include that they are part of a regulatory framework that has been tested over time. Banks face robust regulatory and supervisory regimes proportional to their size and complexity. This supervision and regulation is paired with deposit insurance, providing confidence that deposits held in sizes relevant for most retail purposes will be available on demand and at par. The resolution regime is orderly, which provides additional confidence about the stability of the instruments in a wide range of circumstances and reduces contagion. Moreover, banks have ready access to the discount window, where they can readily monetize assets on their balance sheets at a pre-specified interest rate under a wide range of market conditions, including the most dire. I don't want to say that this system is perfect. It is definitely not. But it is far more robust than what we have developed so far for stablecoins. Thus, it may make sense for both market participants and regulators to consider how tokenized deposits may fit into this ecosystem. As I said at the outset, stablecoins have the potential to improve the efficiency of the payment system, particularly in cross-border applications. For stablecoins to reach their potential, additional work is needed to create guardrails that protect households and businesses and the financial system as a whole. While the Genius Act made important progress in creating a framework for stablecoins, a great deal will depend on how federal and state regulators implement it. If the regulatory framework provides strong guardrails and consumer protections, both the innovation represented by stablecoins as payment instruments and the resulting competition in the payment space could help foster payments improvements that benefit households and businesses. Thank you very much.
So I'm going to be very efficient in the light of payments, and also, the fact that we started a little bit late, and I'm just going to ask maybe one question, and then if anyone has questions in the crowd, the fact that Governor Barr is available is obviously a unique opportunity and resource, and I'm sure there will be other questions. Just to kick it off, what was really interesting, and there was a lot in that speech, but just
Apologies.
No. There was a very rich speech. You're kind of tacking on a macro-prudential lens to stablecoins, and also combining that with a consumer protection lens. All of that gets to the question of what, frankly, the larger ecosystem supporting stablecoins will look like. There being a regulatory ecosystem of what you're really ending on in that state-federal coordination, and then you have the technology question and the other compliance actors who are supporting it, and also frankly a lot of the regulatory requirements and maybe even encoding those requirements, as you had mentioned, on-chain for permissibility and even financial risk management. Is there, in your view, because there's so many things to be done, a preferred maybe order of operations as to sort of how to get from where we are now post-Genius to the kind of financial system that you would like to see evolve?
Well, there is unfortunately a bunch of complexity to the governance under the Act. So we don't have a single agency that can just write the rules for stablecoins, and that's going to make things complicated. But I do think that, starting with the basics that I outlined, AML, anti-money laundering and terrorist financing compliance, making sure the reserve assets are really buttoned down, and then getting in place the capital and liquidity rules. Those are the key, features of the system. And I think, stablecoin issuers that want to be successful in this market are going to want good rules for those things, because it'll mean that the stablecoins are stable. And that's sort of the key feature that you need for stablecoins to be a money-like product.
I'm a law professor. I can ask endless questions. So I'm controlling myself. Does anyone have any questions? Because if you don't, I'm going to ask a bunch of questions. Oh, yes. Please, and then go to the back.
Hi there. Alex Feeney from Stride, based in Hong Kong, and I am building stablecoin infrastructure for banks and NBFIs so that these financial institutions can easily and compliantly accept regulated stablecoins. Maybe a question for you, Governor, is what should I be saying to the regulators and central banks with whom I interface, who are wondering how to process stablecoins locally, right? So they have a lot of local financial institutions looking to them for guidance, because a lot of these economies, especially those close to Hong Kong, are largely dependent on remittances. So they're now very much like a deer in the headlights when it comes to this latest regulatory framework with the Genius Act.
Well, I guess I would say, let's make sure we get the regulatory framework right for dollar-denominated stablecoins, which dominate the market, today. And once that framework is in place, if it's a trusted framework, if it's a strong framework, then you can rely on that framework for the issuance of those dollar-denominated coins. But it is going to require global coordination on regulation. Regulators have to be open to those conversations. They're happening around the world, as you know. So that's what I would say.
Thank you.
And you can identify yourself as well.
Leah McFarland. Thanks for comments. I was wondering if you could speak to the potential impacts on the monetary supply and why that would be of increasing use of stablecoins.
Thanks. So I think for the United States, it's not likely to have a significant effect on how we think about monetary policy. It's just not a significant enough change in how we think about that. There may be, for some small other countries, where there might be large use of dollar-denominated stablecoins, there are more interesting questions about what to do. But it's for us, it's not really a monetary policy question.
Hands? So, okay. Doing my Oprah Winfrey moment. All right.
Thank you. Currently, my name is Bill. I work in the private sector. Currently, it's Just want to get that out there. Currently, the stablecoin market cap is about $300 billion. And Scott Bessent has been on the record for stating that he thinks that the stablecoin market will probably tenfold in the next 2 to 3 years. Do you share that same sentiment as far as the growth of stablecoins when it comes to growth in the future?
Thanks. So first, let me just say I make a habit of not commenting on what other public officials say. So I don't have any comment on the Treasury Secretary's estimates. And I'll say for myself, I don't have a growth estimate for stablecoins. I think a lot of whether there will be significant growth in stablecoins depends on whether it will be used outside of the current dominant use case of crypto asset trading. And for it to be used more broadly in the kind of ways that I was suggesting for cross-border payments activities, it would have to be seen as a real, strong, stable, reliable form of payment. And for that to happen, lots has to happen in the regulatory space for people to have that kind of confidence in the ways that I've outlined in my remarks. So I think there's just a lot of steps in that chain.
You would have to be in the back row, right?
Hi, Governor Barr. Brendan Peterson with Punchbowl News. I wanted to ask you, in terms of the regulatory implementation, things that need to be addressed in the Genius Act, do you see areas, gaps in the Genius Act that need to be amended or addressed by new legislation, or are there things that the regulatory perimeter can't address on its own?
It's a good question. In my remarks, I didn't focus on the distinction between whether legislation would be useful and regulation would be useful. I think we'll have to see what the framework the regulators come up with. I outlined probably too many areas, but in detail the areas where I'm most concerned that regulators achieve a consensus on strong rules of the road so that they're so that stablecoins can be successful. I think after we see the development of that regulatory framework, it will be clear whether additional measures are needed or not.
Okay, so I'll make mine the last question because, as I said, we are trying to avoid traffic jams as the event goes on. Quick, and that's how I'm told that my time is up. Super quick question. Experimentation. In order to get this done, there will be some experimentation. Experimentation has upsides and downsides. For a regulator, it's really tough. As I said yesterday, you're going to get blamed when things go wrong. You'll never get credit when things go right. How do you actually manage experimentation to get, given the fact there is no one single regulator, and there will be some experimentation at the state level for sure, and there's going to be some efforts at the federal level between the different agencies. How do you manage that in a productive way?
Yeah, I think it's going to be super challenging. I mean, again, you have 4 federal regulators and 50 plus state regulators, state and territory regulators, who potentially could develop different systems. The Act provides that state regulation should be substantially similar to federal regulation, so that there is a check on that process, but it does really rely on consensus building. I think if we see experimentation in regulation that is not sufficient to provide the certainty that holders of stablecoins need, that their funds will be redeemable on demand and at par, that's going to create stress in the system. It won't be good for stablecoin issuers. Some stablecoin issuers might seek out those places for short-term benefit, but in the long term, that is not good for stablecoin issuers as a whole. And so I do think it is incumbent on the issuers themselves to say to the states and to federal regulators, we don't want a weak regulatory system. We want one that people can rely on trust in a range of stress conditions so that our use cases can be actually deployed. So I do think it requires some self-interested foresight on the behalf of the stablecoin issuing sector to demand regulation that is strict?
Well, with that, because we don't ever put anybody on the spot, when Corey Thin from Circle stands up afterwards, for,
We'll find out.
Small stablecoin issuer, we'll find out right now. But as part two to this, but let's first of all thank Governor Barr for his time this early morning.
You want to stand? You want to sit? Yeah, I'll pull this chair up. Thank you, Governor Barr. Thank you, Chris. I'm Adam Minehardt, head of policy at Chainlink Labs. I'm joined here with a longtime friend, great colleague, stablecoin warrior, Corey Thin with Circle. We're going to talk a little bit about Corey's thoughts about the governor's remarks here. I think maybe we'll start off and get a sense of your initial reaction to his speech.
Yeah, thanks, Adam. And just, I'm assuming most people know Circle, but we're the largest regulated stablecoin in the world, have facilitated more than $40 trillion of transactions now, a sort of like 12-year overnight success. We were founded back in 2013. Governor Barr, first of all, I thank Governor Barr for his service more generally, but also his work on this. And I thought his remarks were very interesting. For the most part, I agree with everything that he is saying. The way that I look at genius is an old Churchill quote, this is not the end, it's not even the beginning of the end, but perhaps it's the end of the beginning. So there's a lot of work to be done in the rulemaking process. The last thing that we want at Circle is a permissive environment. We think that the standards should be very strict, in particular on reserving, which is what I sort of think about as the essential element of a well-run stablecoin, that you need to be very short duration, no interest rate, credit risk, duration risk, or as minimal as possible. And in many ways, Genius is modeled on the way that we've operated the company for a long time. Our reserves are T-bills, overnight reverse repos, over-collateralized by 1- and 2-year treasuries. That's a mouthful. And then, of course, deposits at global banks. So I think that that's extremely important, and putting some more, some finer points on that in the legislation is good, or in regulation. It's also interesting because I worked on this bill for more than 3 years in its many iterations. We used to call it the McWaters bill. We had a lot of input into it, and you can read it many times and hear something new every time. I hadn't thought much about Bitcoin being potentially a permissible asset. I'm not, I'll have to go look at it again afterwards. But I think something like that is simply not fit for purpose.
And let me follow up on that point, because I think that was an interesting idea that he raised that El Salvador could use Bitcoin repos potentially as permissible reserves. I think the idea of international harmonization is one we're all going to be following as the rules get pushed out. Corey, I wanted to ask you your thoughts on international harmonization and some of those ideas that the governor put out there.
Yeah, so that's the thing. Genius, in our view, is a consumer protection bill, because you have to realize people are using stablecoins one way or the other, whether you like it or not, and the growth is real, and the use cases are real. So before this, there was no framework in the United States, and we would go around to foreign jurisdictions, talk, with, I won't name names, but like all the major jurisdictions that you would think of, and they're saying, hey, what's the United States going to do? We see this use exploding, and it's on the J curve, but we're sort of like dragging our feet waiting for the United States. And many of them ended up going forward and making rules, and now we can harmonize. I've had many conversations with, just since Genius passed, with global governments, and we're trying to play a role as a private sector company, as an envoy here, to make people understand Genius, and then figure out ways that we can work together so that, one, the innovation doesn't stop at borders. That would be a huge disservice to all of the use cases that I think Governor Barr very ably set out. But also, it's a consumer protection issue, right? And we need to make sure that in the event of a failure of a stablecoin issuer, that people are made whole. Now, one of the great things about the innovation is it's supposed to be one-to-one. So if you put the right resources forward with the people, you spend the money, you go hire the right staff, you have strict standards on the front end for AML, KYC, and the like, you should have a very safe institution.
Those are great points. I did want to touch on what the governor began his discussion with, which is, I think, something most of us in crypto really talk about, which is financial inclusion and remittances, and get a sense from you what the reality is in your experience at Circle, seeing these cross-border flows.
Yeah, so remittances are $700 billion global flows every year. I mean, some countries, 40% of their GDP is remittances. And this was always set out as like the first major use case for stablecoins. We've seen, and look, stablecoins are used in crypto trading, obviously, right? But we see that as a bootstrap use case. And the percentage of use of USDC, our flagship stablecoin, continues to increase with like real world activity. And remittances is one of the primary areas. We think that that's very, I mean, in the United States, we have maybe 6 or 7% unbanked, which is kind of sad, frankly, for a country as rich as us. But in many countries, that percentage is much, much higher. And so now with a cell phone, which many of them have access or greater access to that than a bank account, people can be plugged into the global financial system in a way that they haven't been able to in the past.
Now, on the other side, we have the capital markets use cases. Curious your views on that. That's something the governor really didn't touch on, but I think there's increasing discussion about how these instruments are being used in capital markets. Could you go into a little detail about how you see stablecoins in that realm?
Yeah, so for this one, maybe it's not the end of the beginning. This is just the beginning. But it's one of the things that I'm most excited about because the outpouring of institutional interest since Genius was passed is real. And if you think about how much foreign exchange moves around the world every year that's denominated in dollars, if you think about initial margin and variation margin and things like that in derivatives, where collateral is constantly being posted, if you speed up the velocity of money and have instantaneous settlement, you can actually increase economic well-being for a lot of people and also potentially take risk out of the system, right? I mean, that's one of the very interesting things about the technology is, and when you start tokenizing assets that is outside of stablecoins, you need a money layer, but we're no longer like running stocks across the street in New York, paper stocks. Eventually, we're going from T+1 to T+0, and stablecoins can play a role in facilitating that as well.
Yep. Let me finish up with one question on kind of where we sit in the process for Genius implementation. We've seen some requests for comments from Treasury. Some deadlines have been pushed given the shutdown. I want to get a sense from you as to how you're viewing this implementation period, both in the federal government, but also with the states and the role they're going to play.
Yeah, so I mean, probably the hardest thing about Genius to get it done was the state and federal debate. I mean, the Hamilton and Jefferson debates are alive and well, 250 years later. I think it hit a good balance, right? States can serve as the laboratories of democracy. You can go get a state license as an issuer, and the state regimes, as Michael said, need to be substantially similar. I think it will behoove the states to work with the federal government to sort of understand what that looks like. But then there's protections in the bill, like above $10 billion, the federal government has more oversight authority and some shared supervisory authority with the states. To me, that looks a bit like the existing banking system. So I think the drafters did a very good job with a tough political issue.
Yep. Thank you for that. Chris has given me one mandate, and that's to keep everything on time. So with that, I'm going to wrap up. I want to thank Corey. I'm going to give you a few programming notes here. We're going to take a 35-minute break at this stage. Programming will be going on at other stages. Hot tip, the swag is on the 5th floor. So for those looking to up their swag game, 2 bags and a t-shirt. I know everyone's like, no, I'm not into that, but you really are. So 5th floor is where the swag is. Refreshments on 5 and refreshments on 2. Again, really thank you, Corey. Great discussion.
Thanks for having me.